Our next guest is an entrepreneur turned venture capitalist who focuses on early-stage technology companies and sold his own company to Salesforce back in 2007. We're joined by Mark Suster, general partner at GRP. Welcome to Bloomberg West. Great to have you here.
Thank you.
In the studio this time. So got to ask you about Groupon first. I mean, as an investor, given all of the concerns surrounding this IPO, if they came to you, I mean, would you be convinced?
Well, my biggest concern with Groupon, I have two concerns, and I'm not an investor in the company or intimately involved with any of their competitors, but number one is the amount of capital that people took off the table already. Because as a new investor, you want to feel like the existing team is aligned with you to want to go for something big. And when you've taken hundreds of millions off the table, it's hard to believe that.
$800 million off the table.
800 to be specific. And my second concern is defensibility of the intellectual property. So if we look at another big IPO that was in the last year, LinkedIn. LinkedIn has a very defensible business because of the network effect that they have. Groupon, that's less clear. I'm not anti-Groupon, but those are the questions that would concern me were I to be a retail investor.
$12 billion, is that a fair valuation?
Well, let me talk about how companies are valued. First of all, we're valued on a multiple of profits. And in an early stage company, there's obviously less profits. So what you're looking for as an investor is growth rate. So a lot of people are going to be valuing the company on expectations of continued growth. And as an investor, that's what you've got to convince yourself. Is Groupon going to have the ability to grow at a faster rate than other people? What concerns me more, Emily, is how companies are getting valued prior to IPOs, not just in the IPO.
Dropbox just raised $250 million, and it supposedly has a $4 billion valuation. It's like the biggest Series B round ever.
Well, and I will talk about Dropbox, but on Groupon, I believe their last round valuation was $10 billion. So a $10 billion valuation, if I'm not mistaken, going into a 12 is not exactly crazy growth, and we'll see if they get the 12. But let's take Dropbox. Dropbox is a wonderful company. I'm a customer. I think it's a defensible product. They have the best service in the market. But here's the problem, not with Dropbox, but in general. 80% of all venture capital raised by venture capitalists in the first half of this year went to just 7 companies. 7 venture capitalists raised 80% of the money. And so all these billion-dollar companies, which used to be VCs, I think they're growth equity now, are being incentivized to write $100 million checks. And they're pushing up valuations. But if you can't think IPO at a fair price, one questions whether or not you're going to get returns on a lot of these investments.
Mark, it's interesting in this environment. You talk about it doing an IPO, going to the public markets. You've got 2 companies likely rushing out the door right now with Groupon and Zynga, completely different from a financial perspective. One's Groupon losing money, burning free cash. Zynga's doing just the opposite. If these deals get out, do you think it helps support these private market valuations?
Well, here's what I want to say about Zynga. I think Zynga does have a defensible business. Historically, people thought video game companies were hits-driven businesses. But when video moved online, they form one-to-one relationship with their customers. And people who use Farmville can get marched over to Cityville without having to go to a retail store and buy a new game. So it's a much more defensible business, Zynga is. I'm not concerned about whether companies are losing money or not, because often what you're doing in a growth market is investing in growth. So the biggest question is the trade-off between investments in growth and profitability. And if a company's growing fast, I'd almost rather them spend more money on growth. So the profitability doesn't necessarily concern me.
Let me go back to Groupon and talks about the things that investors should be concerned about. There's a class structure issue, and actually Zynga has a similar one, in that there are preferred shares given to the executives. And it's never been clear to me how investors do or how they should treat that. What do you think?
You know, that's a great question. And I have to say the first big company to go with a structure like this was Google itself. And let's take a story of Google versus Yahoo. What Google has had for years is decisive leadership that was able to do big things and innovate. And you look at Yahoo that has been muddled and not innovated for 8 to 10 years. If you look at Facebook and the kind of innovation that Mark Zuckerberg has driven because he has control, I believe that sometimes the short-termist nature of public stock markets mean that people are less innovative because they're trying to hit their quarterly targets. That's what Google wanted to avoid. I believe that's what Facebook will do. That's what Zynga will do. And I actually think in some ways it ends up being much better because of the innovation they drive.
Now, on one hand, you're saying you're concerned about high private market valuations. On the other hand, there's concern about a potential cash crunch because of all of the market volatility, economic uncertainty out there, that some startups aren't going to be able to raise money over the next couple of years as they have been over the last couple of years. You recently tweeted of the cash crunch. It's coming, but I haven't seen it yet. When is it going to happen?
So I don't have a crystal ball, but if I were willing to predict, I guess I am willing to predict, I would say it's likely in 2012. Why? First of all, there has been unprecedented pace of investment over the last 2.5 years. All of these companies that start to run out of cash are going to need to get their next round of capital raised. At the same point in time, we've had a 2/3 reduction in the total number of venture capitalists that exists. So you have massive number of companies that got funded at an early stage and a massive decrease in the number of VCs. And I call that the brick wall that we're going to hit.
So what happens to all of these hundreds of companies that have been able to raise in these optimistic times when they can't anymore?
I think many of them go away. Now, there's an argument that says that they can become ramen profitable. That means that you have very small profitability and you can operate independently. The problem is, to be ramen profitable, you're not paying yourself real salaries. And those people get older and they get husbands and wives and kids and everything, and they go to get real jobs. I think you're going to see a reduction in the number of companies.
Now, talking about the companies that are still attracting all of this investment, Vic Gondotra of Google was on stage at Web 2.0 today talking about Google Plus competing with Facebook. I want to take you to take a listen to what he had to say.
Okay.
The incumbent has a huge advantage. And if you play the same game, that's a hard game to win. We're going to play a different game. You know, it turns out that your friends, your mother, your cousin, they're already on Google. They use it all the time. We've never given them a reason to express their identity in their relationships, and we're going to do that.
How compelling is that argument? You think Google Plus can succeed?
I don't think that's a compelling argument, but Google Plus can succeed. But let me say this. Typically, the large companies have a hard time keeping up with the innovators that come into a market. They call it the innovator's dilemma. And I think Google has suffered from that. This is not the first time they've tried in social networking. I don't yet see anything compelling about Google Plus that unseats either Facebook on one side or Twitter on the other. I think they're really going to have to come up with something innovative to change the game.
So beyond social networking, you're looking for great opportunities. What do you think is the next big thing?
Well, I think all investors seem to be focused on the past, and I'm trying to focus on the future. What interests me is what I call deflationary markets. Look at the great successes of the last decade. If it was Google reinventing the way ads are actually run, whether it was Craigslist with the classified market, whether it's Amazon with books, I'm looking for deflationary markets that create bigger opportunities for new entrants. Social networking did that. I think the next big one is online television.
Really? Why is that?
Well, think about television. On average, American consumers watch 5.3 hours of television per day. It's nearly twice the amount of time they spend on the internet itself. And then if you look at how much time people read, they read on average less than an hour a day. So you tell me what the future of the internet is.
Well, we'll have to see. Mark Suster of GRP, thanks so much for joining us here
Thank you.
on Bloomberg West.